Now, if the price continues to move upward on the pound US dollar, and if the price is able to stay above the next mid-Tiger tunnel, this will be another opportunity to fine-tune our stop loss above the next or below the next mid-Tiger tunnel. But what I like to see is to wait first of all for a candle to close above the mid-Tiger tunnel or the Tiger tunnel, and then the price following through. At that moment, so we have a good opportunity to further adjust the stop loss. By the way, if you consider the global risk on the two trade, you see that the global risk is still negative, but around only -0.5%. So this means that the global risk for the two trade has been divided by 4. Now this blue line, so the pseudo IZ level for the pound US dollar is meaningless, so we can delete the line, of course. It may have a sense on the pound Swiss, but you can see that I have adjusted my stop loss around that IZ level. In fact, it is a coincidence. The better adjustment explanation is just below the mid-Tiger tunnel. Now, I don't measure precisely where the mid-Tiger tunnel is. I eyeball where it is. And if we measure, for example, here, so the two Tiger tunnels, we have a distance of 26.6 pips. So half of that is 13 pips, 13.3. You see, 13.3 is right here. I'm just below. By eyeballing, I'm accurate enough. Let's have a quick look what other pairs are doing. The pound CAD, so you can see after the non-farm payroll, so is rather choppy, so not very interesting. The pound Kiwi has reversed too, but stays in the choppy mode. The pound Aussie, same behavior. The pound yen, so it is reversing, but still choppy. And the Kiwi US dollar, so the price is reversing. That is strange. In this case, that's not strange. The US dollar is weakening, so that's perfectly logical, but it's not a big move. So we had set up here, and the price has moved only 17 pips, so not big movement. And for the Aussie US dollar, same behavior, but not big movement, because the Aussie US dollar is not a very volatile pair. Often not a very volatile pair. Now, what is the difference between using my discretionary decision and not using it, so sticking strictly to the exit setup? The difference is the following. So when you strictly follow the rules, for example, we can see that here in the pound Swiss, with this red candle or the next one of the next one here, so we had perhaps a Tiger tunnel rejection. No, Tiger tunnel rejection is impossible. We are too far away from the Tiger tunnel. But with this red candle, we have so a top in the green obus, across of the two obus. We have a top, an M also in the RSI. So this red candle is an exit setup. If the price follows through, we have an MX. an MX with a small loss. It may be a profit, it may be a loss. And so this makes the following consequence. If we strictly follow the rule when we have an exit setup and the price follow through, we make the MX, whatever the result, we will minimize the losses, but we will also somewhat decrease the profits. But you will have smaller drawdown on the long-term approach. Now, if you follow my discretionary decision, you will have some larger losses with losing trades, but not excessively. Instead of having an average of minus 0.5 R loss following strictly the rules, the average loss will be between minus 0.5 and 1 R. So a little larger, but on the long-term perspective, the profit will be larger. So you will have a little more volatility in the evolution of your equity or balance, and drawdown a little larger. So it's a choice of everyone to decide which approach is best for each one, and if the trader can assume a little more risk, so my discretionary decision approach is the best one, in fact. But this requires two conditions. First of all, you must use a small risk per trade, and my rule is to not use more than 1%. Sometimes I even use a 0.5%, and sometimes even 0.25% risk when I'm less comfortable in some trade due to my understanding of the circumstances. And the second condition is you must perfectly master all the entry and the exit rules. So all the rules of the max must be perfectly mastered. Now we can see that this blue candle here on the pound US dollar has not closed above the mid-Tiger tunnel. So for the moment, so I will not adjust my stop loss, because I have this Tiger tunnel, this mid-Tiger tunnel, and this Tiger tunnel as levels of resistance. I will wait for the close of this candle, and because this candle will most probably close above this mid-Tiger tunnel here, and after that, if the price continue to follow through, but we are approaching the home base here, and even the home base channel, but if the price continue to follow through, then I will adjust my stop loss in this area between the mid-Tiger tunnel, below the mid-Tiger tunnel, between the gray and the green Tiger tunnel, locking more profits on the pound US dollar and decreasing the global risk on the two trades. You see here on the pound Swiss, we may have possibly a max price level rejection, but I will ignore that MX because I have not achieved yet my minimum profit level. The candle now is ready to close in a few seconds. Okay, we have here the possibility for a max home base channel rejection, but because I have already made an MX, so I will ignore that MX, that XX, because we are in the same time window. However, because now the price is following through, I will adjust my stop loss on below this mid-Tiger tunnel here and observe how these two numbers here will evolve. So here, my minimum profit on the pound US dollar has doubled, and my global risk on the two trade has decreased. You see? To only 1/3, a little less than 1/3 of 1%. We may have the possibility for another home base channel or home base rejection. So here. And again, if the price on this last blue candle closes above the home base and follow through, I will make another adjustment in the stop loss because we'll have the home base as the first level of resistance, the mid Tiger tunnel resistance, and the gray Tiger tunnel as the third level of resistance. I will adjust my stop loss below the gray Tiger tunnel. But we need to wait first of all for the candle to close above the home base channel and then above the home base, and then see the price following through. See here we have a max price level rejection, which is very close to also a Tiger tunnel rejection. So if you stick to the rule, to the exit rule, you must make an MX. So in this case with the pound Swiss. And this will help to reduce somewhat the risk on the pound Swiss pair. If you close the two trade now, you will make a 1% profit. Or if you wait for the profit to be about now, for example, if you close the two trade now, you will make 1% profit. If you are able through one or several trades during the day to make 1% profit on average per day, and you trade every day of the week, and you compound your profits, so with the compounding process at the end of 1 year trading, during 1 year, so you will multiply your account by 10, which is completely amazing, with just 1% per day. But this is a big challenge, because making 1% per day, every day of the year, it's a big challenge. But a way to achieve that kind of result is not to focus on the profit you can make every day, but on the way, by applying a correct trading process, by the way of reducing the risk you have on each of your trades. Focusing on the risk first is the must to become successful. So my advice is improve your skills in applying the max trading process, and then you will see that your result will follow. You will never have to worry about your result, but worry about your skills in your ability to apply the rules correctly. And when you achieve that step, this is what I call being consistent with the max concept and rules, then you will see your result following through. I will play the same spiel here with the pound Swiss. If the price crosses my blue line, just for illustrative purpose, but it is not an MX, remember that, I will make an MX just to show how this will reduce the risk on the pair here, the pound Swiss, which is still minus 0.6%, and how this will impact also the global risk. So I am seeing that I can adjust the stop loss also on the pound Swiss. We have one level of resistance, two level of resistance, three level of resistance here. So I can adjust my stop loss below the first green Tiger tunnel. Let's do that way. And you will see that the risk is still cut. It's still halved, in fact, in the pound Swiss. And my global risk now is almost break even. Okay? This means that as soon as I will be able to make an MX on the pound Swiss, I will lock a profit on the two pair. My global risk will be completely cancelled. On the pound US dollar, unfortunately for the moment, the price has failed to close above the home base, so I cannot adjust further my stop loss for the moment. The only possibility to adjust further the stop loss is if the max price channel succeeds to move above the stop loss. So let's pay attention here for the pound Swiss. There is another attempt for the price to cross my minimum MX level requirement. And observe the risk on the pair, so 0.32, so 1/3 of 1%, and almost break even on the global risk. So let's make an MX now. See, now on the pound Swiss, the risk itself has been completely cancelled, and for the two pairs I begin to lock some nice profit. And this is the profit in the worst case scenario if the price hits the stop loss on the two pairs. If I close the two trade now, I will make 1.3% profit. Okay? And you see how the trade risk management is extremely important. Now, if on this candle in around 3 minutes, if this candle on the pound US dollar succeeds to close above the home base and the price follow through, I will make another adjustment on the stop loss below the gray tiger tunnel, locking more profit on the pair and so more profit on the global situation. Now, in this kind of situation, you can ask, okay, what is the level the price can reach in this uptrend? And remember, so the big boys were expecting good numbers for the non-farm payroll. Let's take the pound US dollar here. And we have seen since the London Open or the European Open, a nice drop in the price, with the expectation that the US dollar would strengthen. With the disappointment in the numbers, so we have that reversal, and this reversal can completely cancel the previous movement. And so we can see that now we are approaching that level. So I don't see, so if the price reaches that level, and let's draw, for example, we have a balance area here, clear. So for me, this will be, in fact, a logical place for the price to reach. After that, I don't know. Okay? So I would not be surprised to see the price reacting until that area. So time will tell. But the home base itself, the home base is not too far away from that area, will be also an important area of resistance, as well as for the pound Swiss. For the pound Swiss, the reaction can be perhaps better. The price was in a balance area in all this period, and so this is the potential level where the price can move, but with the home base channel in between the present price and that expected price levels. And this kind of analysis will be valid only if I was right in my analysis, considering that the big boys were expecting good numbers for the employment and the unemployment in the non-farm payroll. On the pound Swiss, the price is reaching, and let's see if it will close above the mid-tiger tunnel, and then if it will follow through, which will be then a nice opportunity to adjust the stop loss around this level here. The mid-tiger tunnel between the gray tiger tunnel and the first green tiger tunnel. We have a nice rejection of the home base. So at this point, you could decide to close that trade. There is no problem at this point. Okay, but because we are completely risk-free on the two positions, I would prefer to stay in the trade as much as possible, waiting, for example, for the trend reversal or a movement exhaustion or invalidation.